Hi everyone, welcome to part two and the conclusion of my analysis on Microsoft. We're going to pick up where we left off last time, which is we finished the model and finished calculating enterprise value of free cash flow and ROIC. So we see that Microsoft's enterprise value of free cash flow most recent quarter is around 37 times. And you can see that the trend it's been going down, which is a good thing, right? It means the company is getting less expensive as it's generating more and more cash over time. So impressively, their free cash flow growth rate in 2020 Q2 was around 17% on a trailing 12-month basis. Q1 was 28%, so very impressive free cash flow growth. Even high, you can see their sales are growing at around 15%, which is very impressive. Nothing to scoff at, but because their margins have been improving, therefore their free cash flow has also been going up. So yeah, you might be wondering, like, why do I focus so much on EV to free cash flow when what's typically what they teach you in like finance classes to look at price to earning. Price to earning is basically market cap over net income. First of all, I mentioned before, net market cap doesn't give you the complete picture. So market cap is just the equity, but a lot of companies, to get the complete picture, have to look at how much debt, right? Why are you ignoring the amount of money that you borrow from the banks, right? That should be accounted for as well. Why are you ignoring financing? And secondly, net income is really an accounting concept that smoothes out earnings, right? Smoothes out earnings because some things are very inconvenient from an accounting perspective. Like if you bought a big asset and you pay cash for it, then your cash flows, and then if you don't like capitalize it, then it's going to look very lumpy and it looks like you have a big loss, even though you're just investing for the future. So accounting likes to it does all this stuff to like smooth things out. But another thing it opens up is manipulation. And like why, like I'd rather use cash flow because it's difficult. You can't really manipulate cash. That's just, you can see how much cash they have in a bank account. And I'd rather get the unadulterated number. And then since like I know what what the accounting line items mean, I can back it out myself. Give me the unadulterated cash number, and I can figure out that the capex is actually an investment rather than something that should be expense. So that's why I like enterprise value of free cash flow. I think it's a more pure, unadulterated measure, whereas earnings tends to be smoother over time, but it can be kind of there's some gamesmanship there. So so I digress, but let us jump into comps. So this is all great, right? Very healthy ROIC, kind of expensive on enterprise value of free cash flow perspective, but let's look at some comps, right? How do we know if it's undervalued, overvalued, unless we look at it in relation to other companies or the broader market? So one proxy I like to use for the broader market is what's called the Shiller PE ratio. And I just talked about how PE is not, in my opinion, as good as EV to free cash flow, but this is what most academics use to measure valuation, is the PE ratio. And Shiller publishes, Shiller I think is a famous a famous guy who came up with this PE ratio, and basically it's the PE ratio for, I think, the S&P 500. Okay, and he basically said, okay, when the ratio gets too high, then you got a bubble on your hands, And you can kind of see that during before the Great Depression, in the dot-com era, and kind of during 2008, but not really, because that was more of a housing crisis, not a stock market, not directly a stock market crisis. So you can see back in dot-com, PE ratio was up in the 40s, low 40s. Today it's 31 times. So basically, they're saying that the average company in the S&P 500 has a PE ratio of about 31. Okay, and Microsoft has a enterprise value to free cash flow of around 37. That's to say, we're making a simplifying assumption that PE is you can look at it along the same lines as EV to free cash flow. So Microsoft is a little bit, I would say, more expensive than the average company in the S&P 500. We can also look at what Microsoft's PE ratio is. Yeah, 36.6. So we're pretty close with EV to free cash flow. So it's a little bit more expensive, but you have to remember right now, large cap stocks like Microsoft, stocks that the biggest like five or six stocks, they've been bid up because one, people think that large cap stocks are more resilient in times like these. Plus Microsoft, it is, there's a reason, right? Because they kind of have a monopoly on enterprise software. They have a lot of pricing power. So also when people buy like an index like S&P 500, it's when you buy one share of that index, you're actually buying more Microsoft just because it's bigger weight of the index. So that's also helping drive up the stock of these large caps like Microsoft within the index. So I kind of get a sense that Microsoft is trading like a little bit more expensive than the S&P 500. But that being said, maybe it's completely justified. It's growing its cash, and it's dominant in a dominant market position, probably in a lot better shape than like an airline, right? Who is also in the S&P 500. Okay, with that in mind, let's look at some other comps. So first company I'm gonna look at is Adobe. Adobe is kind of similar to Microsoft. They make Photoshop, Dreamweaver. Let's see what else they make. Yeah, Illustrator, Acrobat, right? All the stuff that like designers and even people like me, we use pretty regularly. They kind of have a monopoly on these products. So I'm gonna pull up their latest. Actually, I'm gonna use this website. Oops, that's not the one. It's called macrotrends.net, and I found that if you don't want to take the time to like go into each 10Q and 10K off the SEC website or investor relations, just go to this website. It aggregates all the financial statements for you in like a kind of a online Excel format, so it's pretty easy to use, and I found that it's like pretty accurate. I haven't seen them like like miskey stuff. So let's look at Adobe, because we're not trying to do a full model of Adobe, right? We're just trying to kind of get a sense of what it is. Okay, so let's go to the cash flow statement. And the latest annual they have is 2019. Then that's obviously. So let's look at quarters then, because we want the latest information. All right, so Adobe looks like on a trailing 12-month basis. Let's first figure out what it's worth. Come on, what's your shares? Here we go. Shares outstanding, 480. 480? Okay. Sorry, let me just copy this format over. 480, and how much is Adobe today? 499.5. Holy crap. What's Microsoft today? 212. It's gone up quite a bit. Oops. Okay, so that gives us market cap of $239 billion. Is that right? Let's do a quick check. $239 billion, that's correct. Let's see how much debt they've got, how much money they borrowed from the banks. Cash on hand is 5264. And how much debt they've got. Oops. Let me change it to quarterly. They've got 4116 of debt. Which bring that, so that's an enterprise value of $238 billion. So Adobe is at $238 billion, which is, about 16% the size of Microsoft. But they're not. Not everyone needs Photoshop. Not everyone needs like Dreamweaver and that stuff, right? Okay. Now let's see kind of roughly how much cash what's their EV to free cash flow. So on the trailing 12 month, $1,436 plus 1,184 plus 1,325 plus 1,376.8. Okay, they generated operating cash flow this much. Let's see how take out their take out their capex, right? How much they spent on property, equipment, and stuff. So it looks like it's 126 plus 96 plus 94 plus 94.5. Cool. So this is their free cash flow, roughly. Now let's see what their enterprise value to free cash flow is. 48 times. 48 times. So that's about 10 turns higher than Microsoft. So Adobe is much more expensive from an EV to free cash flow standpoint. But maybe they're growing faster and they have even a bigger monopoly. So there could be reasons for this, but now we know kind of in our mind that they're even more expensive than Microsoft. That being said, their operating margin is 32%, whereas we calculated Microsoft's it's actually higher, 37%. So Microsoft has like a higher operating margin as well. So just based on that, like if we're just looking at hold on a sec, I have like OCD, so I need to turn that into times. There we go. Based on that, it seems like Microsoft's maybe not such a bad deal, right? Let's look at a couple other companies. Let's look at Oracle. So Oracle is another one of these companies that if you don't work in like finance or accounting, you might have never even heard of. They make like databases, and most like my company, we use Oracle for the accounting database, and it's basically they kind of have a monopoly along with this other company called SAP, and most companies use one of those two, like for their ERPs, enterprise relation. I don't know what ERP stands for, but basically it's like, just think of it as databases that all large companies kind of need. And they have kind of a monopoly on that product. Like you can't close your books without using Oracle, right? All your data is like stored there. So I think it's not a bad comparison to compare Microsoft to that. Both play in the enterprise space. So let's look at what Oracle is trading at, what the market thinks Oracle's worth. So first, let's see how many shares are out there. 30, 41. How many? What's the price? 59.68. Okay, let me just copy the formats over. How much debt do they have? Debt's found in the balance sheet. Long-term debt, a lot of debt, 67. Six. The heck? Oh. 67,769. What about their total current liability? What's under this? Does that include like short-term debt? This is why it's better to like look at a company's like 10Q and 10K, because they don't break this stuff out, and I don't know what goes in here. Yeah, but since we're just trying to get a rough idea, we're not trying to build a whole model, right? All right, so how much cash do they have? 42,279. Wow, really? So Oracle is also a much smaller company than Microsoft. In fact, it's even smaller than Adobe, even though almost every big company out there uses like either Oracle or SAP databases. Yeah, I'm gonna figure out what is it called, the product they use. Database software, yeah, so it is database and enterprise software. Oracle ERP, enterprise resource planning. So that's what the technical name for it. Almost every company out there uses it. Yeah, actually that surprised me. They're even smaller than Adobe, about 15% the size of Microsoft. But maybe they don't really make any money. Let's see. Cash flow statement. So let's see how much money they generated. Okay. Operating cash flow. How much did you guys spend on CapEx? 436, 433, 396, 349. Well, this is interesting. So Oracle, despite being quite similar size to Adobe, much smaller company, is only trading at 18 times their free cash flow, which means so they generate over 2 times more cash than Adobe, Therefore, they have like less than half the multiple of Adobe. It's a much cheaper company, relatively speaking. That may be because, I mean, one couple of reasons. One, they're not like as monopolistic as Microsoft or Adobe. Whereas if you don't use Microsoft products, if they're like, oh, we're gonna get rid of Excel, you literally can't do your job. But with Oracle, maybe you can switch to their competitor, which is called SAP. So they're not as like dominant and monopolistic, but I think it's pretty hard for companies to like switch. But maybe they're not growing, they're not growing as fast. Like maybe their cash generation has been fairly stagnant. So let's look at last year, how much cash they generated. Yeah, so last year they actually generated even more cash than this year. Oh, actually, yeah, about the same. So their cash generation hasn't been going up. So what about their revenue growth, revenue and profit? Actually, let's look at Adobe's cash generation, cash flow statement. So Adobe, on the other hand, yeah, Adobe's cash generation went up by 28%, whereas Oracle's is flat. So obviously the market is, market is making assumption that Adobe is going to be able to grow their cash generation, and therefore they'll grow into their multiple like over time. But I don't know, is it going to grow so much that justifies like a 50 times multiple? That I'm not sure. It's even much higher than Microsoft. And finally, we'll look at our last comp, which is a company which I've analyzed before, Apple, the first company I analyzed. And so Apple, we can pull up the model we did for Apple, right? So Apple was trading at around 29 times. Okay, so we're kind of all over the board here. We have Apple at 29 times, Adobe 48 times, Oracle 18 times, Microsoft at 38 times. And let's see how fast was Apple growing. So Apple was growing their revenue about 11% year over year. Whereas Microsoft actually has higher growth than Apple. That I didn't even know. Microsoft's growing their revenue faster than Apple, trading at a bit more expensive than Apple as well. What about their return on capital? So Apple's got Microsoft beat on return on capital, right? 29. Yeah, about pretty similar actually. They're very similar stats. But Microsoft is more expensive than Apple, interestingly. Is that because their free cash flow is not growing as fast? Yeah, it's not. So their free cash flow only grew by, let's see, Q3. I don't have full year data, but about 21 times, 21%, 22% versus Microsoft. Yeah, to really do this, I need to model out more quarters of Apple, so we get more apples to, no pun intended, apple to apple comparison. But yeah, so this doesn't really, it's not a clear-cut answer, right? Because you got companies that are more expensive, companies that are much cheaper but not growing as fast. But they're all good companies to look at to get a sense of comps. I mean, it does tell me that Microsoft is not like a no-brainer, that it's cheaper than the average company, right? We also know that compared to the average S&P 500 company, Microsoft's a bit more expensive as well. So yeah, these are all good information. So like in terms of kind of investment thesis, one, office or monopoly in enterprise software. This is a true cash cow for them. I'm talking about office products, software, office productivity, right? So this generates a lot of cash for them that they're able to invest in projects. Some of them really dumb projects. Like remember there was they try to compete with the iPod with this thing called the Zoom. Ended in failure. Secondly, clouds, growth of enterprise cloud service. Cloud is killing it, especially during this environment. Risks, one, valuation, very expensive relative to average S&P 500. Oh, and healthy ROIC. Healthy ROIC, yeah. What I mean by monopoly in enterprise software is like, in next 10 years, I think we'll still be using Microsoft Office products. I just don't see it going away. There's no alternative for it. Another one risk is like we discussed, valuation is pretty elevated compared to Apple, Oracle. So you really have to believe that Microsoft is gonna continue its trend of just generating more and more cash. But then you run into kind of what's called the law of large numbers, where it's more and more difficult to grow once you become so really big. And Microsoft is huge, right? Microsoft is a $1.5 trillion company. So it becomes harder and harder to grow larger when you're already huge. Valuation is pretty expensive. What's another risk with Microsoft? Honestly, Microsoft is a very good business. It has a very good cash cow, and this is why it's been bid up so much, because it's such a good business, such a repeatable cash flow, recurring cash flow that just won't go away, right? And also with huge barriers, right? Like who can compete with Microsoft in what they do, right? It takes huge investments to compete with Microsoft in cloud, right? You have to build all the servers, cloud server data, server farms, all that stuff. It takes a large amount of capital to build that. Really can't compete with them on software. You're just and there's another thing going for them it's called network effect, which is related to number one. What that means is that let's say you start out, starting out there is Microsoft and there is let's say Lotus, okay? And they both have both make word processors. And then in the beginning, Microsoft has like 50% market share and Lotus has 45%. But because Microsoft has a little bit more market share and more people use Microsoft, eventually it's what's called network effect, where I'll just even look it up for you. Yeah, so that an additional user, the value of a product or service increases according to the number of others using it. So because there are the more people that use Microsoft software, the more valuable Microsoft software becomes. Because let's say if you have like 80 people using Microsoft, then if I'm a new user, I'm gonna use Microsoft, because I don't want to use something that 8 out of 10 people can't use, right? So the more user that Microsoft gains, the more popular Microsoft becomes. The more more appealing it is to the new user, even though it's like, let's say starting out, these two are like very similar products that offer very similar values, just because by luck or something, Microsoft happens to get more users, then it enjoys this network effect. And that's definitely the case for a lot of Microsoft's products, and that's how they became dominant. That's why no one is typing up Word documents on Lotus anymore, because they got pushed out by the network effect. Similar with the cloud service, right? Like right now you've got two giants, Amazon and Microsoft, and if they build their cloud in such a way that like, let's say the cloud engineers are let's say there's two different languages, Microsoft and Amazon, and the cloud engineers who are training this stuff can only specialize in one language. So if one of them gains like an edge, then they're going to start enjoying network effect, because more people are going to learn like the Microsoft language, and they're not and then more and more people they'll start enjoying the network effect, right? So right now it's not clear who's winning, right? They're kind of equals, but this is, I think, another area where that could show up. But I just wanted to explain kind of what network effect is, and Microsoft historically has been a huge beneficiary of that, right? Because they think about it, like Microsoft's had a lot of competitors, even back in like Windows has had competitors. And why is like Windows on every PC now over time? And that's largely due to network effect. It's not really. It's not 100% due to the fact that they have the best software, right? Like there's other softwares out there that are maybe just as good. So so I'm kind of like rambling on a little bit, but in conclusion, it's not like a screaming buy for me, at least personally. It's because of how expensive it's a great company, obviously, but it seems to me that the market kind of knows that and has priced that in to the stock price, right? So unless I have some differentiated opinion on this company, I think it's hard to imagine like Microsoft like doubling from where they are. Okay, that's it for today. Thanks for watching.